purpose of this video is to discuss long-term liabilities, and specifically the accounting for long-term liabilities according to US GAAP. So the first thing I'll say is that whenever you have long-term liabilities, you record them at the present value of future cash flows. So as a simplistic example here, if I have to pay $100 in N amount of periods, whatever that may be, and I determine that this is a long-term period and is more than 1 year or one operating cycle for the business, then I have to actually get that future value, because this here is your future value, and I have to bring it back to the present, to a present value. So you can use tables, you can use the calculators, or even here you can specify the present value of some payment. And let me just make up a rate. Let's say that the rate is 5%, and the number of periods, just to make this up, is 3 periods. The future value we said is $100, and this is an end of period calculation. So if I were to do that, it says that this $100 to be received 3 years from now, that's what I did, discounted at 5%, this would be like the market rate that you discount at, is worth $86.38. And the calculation here is not the important thing. It's understanding that that amount that you record on the books is going to be less than that future value. Now, I want you to contrast this with current liabilities. And there's a video discussing current liabilities. And specifically, the current liabilities are recorded at the maturity value or the face value. In other words, that future value. We don't discount them if they are current. So what is current? Well, a period that is less than either the greater of the operating cycle or 1 year. Usually just less than 1 year is what you got to think about, right? Unless the operating cycle is more than 1 year. So you would do, if you have a current liability, you would just put it in at the face amount. In other words, if, just to contrast, if I determine that it's a short-term liability, then I record it in the books at $100, that future value, okay? Not the present value. And that would be the face amount. Okay, but in this video, we're going to talk about long-term liabilities, but do understand that difference there. So normally with long-term liabilities, there's usually a little bit more work because of the fact that you have to do this discounting effect. A long-term liability normally involves formal agreements that will dictate the rate, the maturity date, any call provisions, meaning whether you can call it in early to pay it off, sinking fund requirements, requiring the company to put money aside, the one that borrows the money. And very important, even though we have long-term liabilities, there's usually a short-term portion of that long-term liability that is removed. So, with bonds payable, with notes, mortgages, all that kind of stuff, whatever the current portion of that liability is, in other words, whatever amount is due within the next operating cycle or year, that stuff needs to be separated to current liabilities. Okay, so let me give you an example. What's a common example of long-term liabilities? Bonds, dealing with bonds, right? So let me give you here some information about a company. ABC Company issues a bond for $100,000 for 3 years at 12%. with interest paid annually. Okay. Now here's something that needs to be said so that you understand why we do certain things. This right here is referred to as a negotiable instrument, a financial instrument that cannot be changed. So in other words, even though I created this bond with 12% interest, if the market rate goes up or down, I can't simply change this 12% or any of the terms for that matter in this bond, because of the fact that it's already in the form of a negotiable instrument. So it'll exist for its life, in this case 3 years, with these terms, and you cannot change it. So because of that, anytime that interest rates go up or down, we have to adjust externally to the market conditions. And that's what I mean by that is we have to either sell it at a premium or at a discount, right? And those are the reasons why we do that is because we cannot change the interest rate here. We just have to adjust the value externally from the bond. All right, a couple things I'll say here as well. I am going to illustrate in this video the accounting from the issuer's perspective. This is the borrower. So the person that's borrowing the money, that's the accounting that we're going to do right here. Do not confuse it with the accounting that the investor does. In other words, the lender, whoever's lending us the money, that's an investor. And for that, we have investment accounting. And if you'd like to understand how the investor or the lender's accounting is done, I have a video for that, and it's called Investing Accounting. But just to kind of briefly give you an idea, for the investor, the person lending out the money, they have to either classify that investment as held to maturity, trading security, or available for sale. And depending on the classification, there's different accounting. But again, this right here is not what we're illustrating in this video. What we're illustrating in this video is how do I account for it as the person borrowing the money. Okay? And just to be clear, the person that borrows the money technically is the person that issues the bond. The person that is, or the company, I'm sorry, that issues that bond is the one signing and agreeing to pay money back. So they are the issuers of that payable or that note or that bond in this case. All right, so let's look at an example where the market rate has gone down to 10%. So in other words, our bond, as I said earlier, pays 12%, but the market has gone down to 10%. If that is the case, then our bond paying 12% looks more attractive, right? Given that it looks more attractive because it pays more than what the market's paying, then we can sell it at a premium. And for the most part, this should be a review for some of you, but nevertheless, I'd like to just kind of go into a little bit of detail so we are clear. So how do I determine this amount, 104,973? How do I determine that I actually get 104,973? Well, let's go back to this. Long-term liabilities are recorded at the present value of future cash flows. So we're going to have to look at all the future cash flows for that bond and then discount them at the market rate. So let me illustrate down here. So notice that if it's 12%, that means it pays $12,000 per year for 3 years, right? So on a side note here, let me show you how I did that calculation. So the first thing is I'll lay out the principal. So this is made up of two parts right here. Here's the principal, and then here's the interest. And you have to analyze them separately. So the first thing is after 3 years, somebody will receive $100,000. So I'm going to discount that $100,000 at the market rate. And that's very, very important, okay? You always, always, always discount at market rate. And the reason I say that is because usually there's two rates that we're dealing with. We're dealing with the coupon rate or the stated rate, and that's what's on the bond, and then the market rate, right? So they may be the same, but most of the times they're different. So when I do the discounting effect here, it has to be at the market rate always. So once I do that, I get a present value. Let me open this up a little bit. So the present value of $100,000 discounted at 10% for 3 periods is equal to $75,000 roughly. Okay, so this $100,000 in the future is worth $75,000 today at a discount rate of 10%. Then I look at the interest. Okay, so these cash flows are based on coupon, and that should be really important to you. Cash flows based on coupon rate. And then, as before, discounting at market. And this is a rule that you can pretty much always go by. Maybe we should highlight that. So notice how the cash flows that I'm putting in here, those are $12,000. That's based on the coupon rate. This will never change, okay? It will always be $12,000, and it's always based on the coupon rate. Now, once I lay out those cash flows, I discount them at the market rate. and that gives me that roughly 3 payments of $12,000 over the next 3 years. The present value of that is $30,000 roughly, right? So that's where, if we sum up the present value of all future cash flows, that's where I'm getting the 104,973 that I put up here. Okay, so here's the 104,973. If you were in a premium situation, in a discount situation, your market rate would be higher than 12%, right? So you just discount at the market. Whatever the market is, this is what changes. Whenever you're doing these computations, this here never changes. This here never changes. That's always based on the actual bond. What is constantly changing is how we discount it on market rate. If you remember that, you'll avoid problems in doing these calculations. Okay, so we've figured out where this 104,973 comes from, right? We're going to issue it at a premium. So here's your bond payable, 100,000, and then here's the premium amount for 4,973. So I'm going to illustrate here with a T account just so you can see where this is, what's happening here. The premium starts with 4,973 as shown right here. Now at the end of year 1, this is 12/31 now, I have to compute the interest expense and then the amortized amount. Now notice something here that's important. This cash amount, and maybe I'm exaggerating at this point, but I just want to make that point very clear. This cash amount of 12,000 never changes. It's always 12,000, no matter what happens in the future. And the same thing goes for the cash that you got to pay back at the end. That's always 100,000. So those things don't change. Those future cash flows based on what's stated here never change. All right, so how do we do this computation? How do we compute what X is right here? And I had an X here, I guess, and I took it out. So the idea is that in the past, you learned the straight line approach to amortization. Let me remove the fill here. So in the past, you learned, I guess this is the X I was talking about here. Just so we understand why I wrote X there. So the question is, what is this X value? Okay. So in the past, you learned the straight line method. And perhaps that was done for purposes of limiting the number of new things you were learning. So just keeping it simple was, hey, take that whole premium, 4,973, and divide it by the number of periods, and you get some amount. But this method doesn't work. Okay, this is not what we use in reality. This is maybe easy for purposes of learning the material, but really what needs to be used is the effective interest rate method. So I'm going to just cover that up as if you've never learned that. Okay, we're going to think about it as this is something you've never seen, and what you will learn, or what you should be using, is the effective interest rate method, which is the better approach. And it's the correct approach, in other words. And with the effective interest rate method, we're always computing what the expense incurred, okay, for GAAP purposes, what the expense incurred is, and then the amortization is simply a plug amount. So the formula is always going to be as follows. You get the carrying value at the beginning of the period. So the carrying value at the beginning of the period was 100,000 plus 4,973. So that's a total of 104,973 times the market rate. So for your expense incurred, you're going to use the market rate again. So that gives me $10,497.30. So that goes right here. Then I subtract to get my plug amount. So I subtract the 12,000 minus 10,497, and I get 15,027, and that's this premium amortization. So at the end of X1, it might help us to have the years here. At the end of X1, I'm going to amortize, in other words, remove from the premium 15,007, giving me an ending balance of 3,470. So this is important because this is the amount that I'm going to use to compute the carrying value for year 2 computation. Because remember, the expense is always the carrying value at the beginning times the market rate. Now, we're doing this computation yearly, so it's the carrying value at the beginning of each year. But think about it. If you're doing it quarterly, it's the carrying value at the beginning of that quarter, or monthly, etc. All right, so let's go ahead and do year 2 then. One more year passes. We have interest expense. So I'm going to compute this using the carrying value here. And the carrying value at the beginning of year 2 is the bond itself plus the ending balance last year, which is 3470.30, and that's what this is right here. That gives me an interest expense of 10,347, which is what you reflect here. And again, this is my plug figure. I computed based on the difference here, and once it's posted for X2, that's what I see here. Now my ending balance is going to be 1870. Now, I'm sorry, 1817. The last year is one that is a little quirky. I will not do this calculation because the last year I just need to get rid of the remaining balance. So it's almost like you're now making this the plug figure. So for the last year, I'm going to just take out the whole premium that remains in there, 1817. This doesn't change, so the difference is going to be your expense. And if you were to do the computation of carrying value at the beginning times the market, it would come out to be very close to that. Okay? So there's your calculation for the third interest payment. Notice that after I do my third interest payment, the balance in the premium account is 0. So at that point, at the end of year 3, the carrying value of the bond will be 100,000 plus 0. And as it's at that point that I also have to pay back this loan, right? So I have to credit cash and then I reduce the liability, hence eliminating the balance in bonds payable. Okay, so there's your illustration on how we account for this particular long-term liability called bonds payable. I provided you with an example where the market rate was below our coupon rate or stated rate. So in that scenario, we sell it at a premium. The other potential thing that could occur is that you sell it either at a discount or at par. So let's look at this scenario here where we sell it at par. So we're done, we fully explained how to do the accounting here. This is just, what if the market rate were different? If I am paying 12% and the market is 12%, then the bond just sells at par. And it's very easy because every period I just do expense for 12, cash for 12. I don't need to account for any discount. I don't need to account for any premium. You would do these 3 payments, and then at the end you would have this same entry right here. All right. If on the other hand you find yourself in a scenario where the market rate is higher than what you're paying, all right. So at the end you did a bond for 12%, but a similar instrument of that risk is now paying 14%. Well, at that point you're going to have to discount the bond. And you calculate the present value of the future cash flows just like I did down here. The same way, this doesn't change. As well as this doesn't change. The only thing that you would modify now is that instead of discounting at 10%, you would discount at 14%, which is the market rate. And if you do that, then you get 95,357. Here's your discount. And then every period, your journal entry would look like this. The computation would be the same. You do, at the end of the period, carrying value at the beginning of the period times market rate. In other words, times 14%. And the reason we do that, the reason we adjust the price, so let me highlight this. The reason this price of the bond either goes up or down, in this case, it went up because we sold it for more, or in this case, it went down because we sold it for less, doesn't necessarily imply that we have a gain or a loss. Okay, I want you to be very clear on this. We're simply matching what the market is. So in other words, even though my bond says 12%, and I hope you can stay tuned to these couple statements I'm going to make. These are real important statements. Even though my bond says 12%, if the market is paying 10%, then whatever cash I give you, the investor, whatever cash I give the investor, in this case $12,000, it better turn out to a return on investment of what the market is, which in this case is 10%. So in other words, let me do it a different way. If somebody gives me $100,000 and at the end of the period they give me interest of $12,000, that's clearly 12%. 12,000 divided by 100,000 is 12%. And that's the return on investment. That's the effective rate that they're going to get, because that's what the market is. Now, something like this one, if I pay somebody $12,000 for a loan of $95,000, that $12,000 is going to give them a return on their investment of 14%. And that's just simply because that's what the market is. So in other words, this is a rough calculation, but 12 divided by 95, 12,000 to be clear, divided by 95,357 will give you that return of 14%. So you are adjusting your base here. You're receiving less because you can't change the terms. Remember, you can't change the terms of the bond. But what we can do is change the price at which we sell it. So that somebody that gets paid $12,000 for having invested $95,000, they will get a return on investment of 14%. And the same thing goes right here. Somebody that gets a payment of $12,000, let's do it right here. Somebody that gets a payment of $12,000 for something they paid $104,973, this will give them a return on investment of 10%. So look at what we're doing here. Every time that we adjust the price at the beginning, the reason we're doing that is because we're trying to make this $12,000 provide a return that is based on what the market is paying, always. All right, so hopefully that helps you understand a little bit about bonds. I will do another video on bonds, how to account for bonds, specifically with when you issue bonds between interest payment dates. So in other words, this bond, I should have put a date on this bond. Just put a date here, just so you understand what I'm saying. X1. So if this bond is dated X1, 11X1, if we issue it on 11X1, perfect. There's no craziness. But if we issue it somewhere between 1/1 and 12/31, then we have to do some accounting, because that would be selling it between interest payment dates. And I encourage you to watch that video as well. That one will illustrate how we have to always work around the bond itself. Recall that this is a negotiable instrument and we can't change the terms within. So because of that, we have all these little quirky things we do that is outside of the bond. And by quirky, I mean, like, look, if the market is 10%, why can't we just go in there, cross this out, put 10% and sell for 100? Well, we cannot do that because this is a negotiable instrument that is being traded, perhaps. So for that reason, we have to adjust the price, and the bond itself stays intact. Okay? All right, this concludes the video on long-term liabilities with an example of bonds.